Inheriting an annuity can be a financial windfall, but there are important considerations for your taxes and your options for what to do with it. The first thing to know is that there are two types of annuities from a tax perspective: qualified and non-qualified. A qualified annuity just means that the money was usually saved in something like an IRA or a 401k, and that taxes haven't been paid on it up front. So that means when you take money out of the inherited IRA, there are taxes due, usually in the form of an ordinary income tax rate, which can be relatively high. So you have a few options, depending upon your relationship to the person who passed away that you inherited the annuity from. If you're a qualifying spouse or something like a minor child, it gives you a little more flexibility to spread out the payments. If you are any other kind of person that receives that inherited annuity, though, you'll really want to think about the tax consequences of either spreading this out over a few years or taking what's called a lump sum distribution. This is when you take all of the money out at once, and it can have a pretty big tax impact. Non-qualified annuities, on the other hand, had money that was put in initially that already had taxes paid on it, so the original amount of that annuity has no more tax due. There could be some growth in the annuity, many of those have that, and that usually will have some tax due, usually also in the form of ordinary income tax rates. It just means that a non-qualified annuity has a little bit more flexibility for your own tax situation as the inheritor. A final thing to know about both types of annuities is that you can exchange them. This is called a 1035 exchange. And if the annuity itself has like really high costs or not good investment options in some cases, an exchange might be appropriate. Reach out if you have questions about inherited annuities and how it could fit into not only your tax planning but your overall financial plan.